Welcome to the deep dive. Today, we're jumping right into the pretty intense world of Wall Street in the mid-90s.
That's right. We're using Frank Partnoy's book, Fiasco, as our guide. Specifically, the bits you sent over about his move from First Boston to Morgan Stanley.
Yeah, to their derivative products group, the DPG. It sounds like quite the place.
Definitely. And our mission here is to really, unpack that culture. What were these investment banks like then?
And get a handle on derivatives themselves and, well, how they were sold, the tactics.
Exactly. Because the numbers are just staggering, aren't they?
Right off the bat, yeah, Morgan Stanley's DPG, $1 billion in profit, with only about 70 people.
Mm-hmm. And young people, too. Partnoy himself was, what, in his 20s?
It's wild. So much money, such young guns making it happen.
But it's key to know, Morgan Stanley wasn't always like that. The book points this out.
Oh.
Yeah, they had this older reputation, first-class business, first-class methods. Very prestigious, maybe a bit staid.
Okay, so what changed?
Well, the 80s happened. Competition ramped up.
Oh.
And suddenly, the unofficial motto shifted. It became first-class business.
Second-class methods. Oof, that says a lot. The ends justifying the means, maybe.
It leans that way, doesn't it? And this guy, John Mack, Knife Mack, he was a big part of that shift.
Knife Mac?
Yeah.
Wow, what was his deal?
Total focus on aggressive sales.
Yeah.
Boosting trading revenue. He apparently had this metal spike on his desk.
Seriously?
Yeah, and a broken phone in a case, like a trophy from his trading days. It just symbolized this relentless drive.
Okay, intense pressure cooker environment.
Totally. And the excerpts show this aggression wasn't just talk. Inside the DPG, immense wealth, but also this ruthless vibe.
The language they used, tear someone's face off, shoot someone, it's pretty shocking stuff for an office.
Mm-hmm. And it spilled outside work, too, didn't it? Shooting clubs, hunting.
That FIASCO clay shooting competition, even the name, it's like they're leaning into the chaos.
Right, and all this is happening while the actual derivatives market is, well, kind of imploding in places.
Yeah, the book mentions huge losses everywhere. Orange County, Barings Bank.
Daiwa, Procter & Gamble, Allied Lions, mutual funds.
The Mexican peso crisis. Billions just vanishing.
It's mind-boggling. The market was, what, $55 trillion in '96?
Double the value of all U.S. stocks then. That's insane.
And the losses just kept mounting alongside the growth. It makes you wonder about these instruments.
Which brings us back to Partnoy. He wants in on this, moving from First Boston. Why Morgan Stanley?
He saw it as the top tier, the best place for derivatives. Even though he was already doing derivatives at First Boston, he wasn't a newbie.
Right, he was a broker there. But getting the Morgan Stanley job sounded like a covert op.
Huh. Yeah, the headhunters, the secret meetings, code words.
All for that better opportunity. It must have seemed like the promised land.
Especially compared to First Boston. The excerpts paint a picture of a firm really struggling.
Second tier, he calls it. Losing people left and right.
Yeah, that burning bed loan disaster, selling off parts of the business just to pay bonuses.
The nickname Wheat First Boston, ouch.
It doesn't exactly inspire confidence, does it?
Not compared to Morgan Stanley, the hottest derivative shop on the street. You can feel Partnoy's excitement.
And the interview itself, what a contrast. Fancy client floors upstairs.
And then the dungeon-like trading floor downstairs, it sounds like sensory overload.
Totally. Phones ringing off the hook, screens flashing, shouting. Chaos.
And he notes the difference between the traders and the brokers in the middle of it all.
Right. Traders all intense, sleeves rolled up, while brokers are juggling calls, maybe a bit calmer on the surface.
It's a specific world. And a very homogenous one back then, based on his description.
Yeah, the lack of diversity really jumps out. Mostly white guys from elite schools.
And the way women were treated,
Yeah.
the beauty factor hiring, the limited roles, the harassment anecdotes, it's appalling.
It really underscores the culture at the time. And yet, Partnoy says, despite seeing the flaws.
He felt at home there.
Yeah, maybe it was just the reality of that world, the cost of admission.
And he joins this department, the DPG. And here's about FIASCO, again with the name.
It's like a badge of honor almost, a weird bravado.
And the money talk bars, millions of dollars.
That's the goal, right? Earn your bars. It's all about the compensation.
Morgan Stanley, the money machine, smartest people, most creative derivatives, a gold pot.
Especially compared to First Boston's fading image. Even the buildings reflected it.
Right, First Boston's Park Avenue Plaza, not actually on Park Avenue. Dated building, homeless people in the lobby.
Well, Morgan Stanley's in Rockefeller Center. Modern logo, global feel, projecting power.
It's funny how different they seemed then because they were once equals, right? Post-war giants.
Exactly. But first Boston faded, except maybe for those express elevators for traders. Got to
Yeah.
keep the moneymakers happy, I guess.
So amidst all this, the core question, what are derivatives? Partnoy says even at First Boston, people didn't always get it.
Right. You have the textbook definition value derived from something else, like stocks or bonds.
But Partnoy's definition is maybe more practical. Financial inventions that suddenly blow up and make headlines.
Yeah, that feels closer to the mark sometimes. And remember, he had a law degree, not finance. He was learning too.
And he spares us the super technical jargon, which is appreciated. Adjusted duration, negative convexity.
He figures you don't need that to grasp the basic scam. I mean,
Huh.
strategy.
Huh. Yeah. And the profitable stuff was secret, right? Like a golden goose.
Absolutely.
Yeah.
Why share your edge? He hoped Morgan Stanley would be more open, but probably not.
So the basics, options and forwards.
Pretty much. Options give you the right to buy or sell later. Forwards give you the obligation.
Like his Conway car analogy. Option is the deposit, forward is the firm agreement to buy.
Exactly. And then there's the difference between exchange-traded ones, more regulated, visible.
And the over-the-counter OTC market, private deals, less transparency, that's where the really wild stuff happens.
Seems like it. Deals hidden away inside the banks. And the complex ones just combined options and forwards in ways that were really hard to value.
Which explains his disastrous interview at Bankers Trust.
Oh, yeah. Getting fired mid-interview because he couldn't figure out a billion-dollar trade on the spot. Yikes.
Key lessons there. Someone wins, someone loses in every trade.
And you better be quick with the math, preferably in your head.
Which leads to present value, right? Money today is worth more than money tomorrow.
Fundamental stuff, because you can earn interest. So future money has to be discounted back to today's value.
And that's how you price bonds. Add up the present value of all the future coupon payments and the principal.
That's the core idea. Then you get into trickier stuff like duration and convexity, how sensitive the bond price is to interest rate changes.
But Partnoy simplifies it. Duration is risk, convexity is good, negative convexity is bad. Good enough for us.
It helps grasp the essentials without getting lost in the weeds.
Okay, so back at First Boston, bonus day is looming, the Valentine's Day massacre.
Sounds ominous. And everyone knew people would grab their bonus and run, right?
Standard practice, it seems, shows you the loyalty level.
It's transactional. Get paid, look for the next best offer.
And even though the bonuses were probably huge by normal standards, everyone felt cheated.
That herd mentality. It's all relative. How much did the guy next to you get?
Plus that detail about the bank holding the checks over the weekend at Citibank to earn extra interest.
Every penny counts, I guess. Even when you're paying out millions.
So Partnoy gets his check, resigns, joins the stampede out the door, off to Morgan Stanley.
Using the offer as leverage, the standard better opportunity line, meaning pay me more.
And then the exit escorted out by security, body search and all.
Intense. Shows how paranoid they were about secrets walking out the door. His briefcase was clean, though.
And just one day off before starting at Morgan Stanley. No break.
Unlike that Vegas trip he took before First Boston. That didn't end well, did it?
No. Card counting, winning big, getting kicked out, then losing it all back. A good lesson for a trader, maybe. Don't overstay your welcome.
Or your luck. Seems relevant to derivatives somehow.
So, Morgan Stanley, founded in 1935 to Wall Street, came out of J.P. Morgan because of Glass-Steagall.
Right. J.P. Morgan had to choose. Commercial or investment banking. The investment guys left and formed Morgan Stanley.
And they've been a top firm pretty much ever since, unlike others who rose and fell.
Their early rep was very conservative, though. Blue chip clients, underwriting monopoly, no traders till the 70s, proper business.
But then rivals like Salomon and Goldman started making bank from trading.
And Morgan Stanley had to adapt. Mid-70s, guys like Barton Biggs, Bob the Ultimate Warrior, Greenhill pushed for change.
But they were slow to embrace the riskier stuff, missed the early M&A and junk bond booms.
Yeah, Drexel and Milken owned that space. Morgan Stanley was hesitant about disreputable clients.
Until Revlon in '85, that Perelman deal with Drexel.
That seemed to flip the switch. They made, what, $25 million in fees? Suddenly, high risk, high yield looked pretty good.
And then bigger deals like RJR Nabisco followed. More trading, more brokerage.
And then they went public in '86. Partners got incredibly rich, but the firm's character changed. New clients, more controversy. They were back on top, but different.
The shotgun wedding, with risk, and derivatives were a key part of that new engine.
Absolutely. Which brings us back to the DPG. Small group, maybe 70 people, but hugely important, sitting right between IBD and FID.
Right, the acronyms. IDD is investment banking, M&A, corporate finance, pitch books.
Grueling work. Partnoy wasn't keen.
And FID is fixed income brokerage, trading floor action, more volatile, higher stakes, more Partnoy speed.
And DPG is the bridge. Uses IBD's clients, FID's trading smarts, located centrally on the floor.
Supposedly a joint venture to stop IBD and FID fighting over bonuses from derivative deals.
That was the idea, because those two groups, bankers and traders, were like oil and water culturally.
Conservative bankers versus aggressive traders. Different clothes, different food, different language, firewalls between them.
But they needed to cooperate for derivatives. Remember the JP Morgan split. Internal conflict is dangerous.
And DPG itself was brand new, really. Post-1990, Morgan Stanley was late to the derivatives game.
But innovation was happening incredibly fast. Structured notes, interest rate swaps, mostly invented in the 80s, early 90s.
And DPG jumped in, selling high-risk leverage stuff early on to wealthy clients, Middle East, Asia.
Yeah. Sometimes those clients lost big, but apparently kept coming back.
And the volume was huge just before Partnoy arrived. Hundreds of deals, $25 billion in financing, tons of complex products.
And the client list grew. Corporations, hedge funds, mutual funds joined the wealthy individuals. Brokers just followed the money, selling whatever was most profitable.
Which led to that $1 billion in commissions in 2 years. For 70 people, where did all that money go?
Spread around the firm. But you can bet the DPG folks got a massive chunk. They were driving the profits.
But it sounds like a house of cards, maybe. Building this huge business on complex, opaque stuff.
There was definitely that perception, high risk.
And who was running the show? The Four Horsemen.
The four senior managing directors of DPG, Peter Judderson and Steve Bernardet in New York.
George James in London, Paul Daniel in Hong Kong.
Right. Judderson was the overall head initially. Bernardet was politically connected. James in London was seen as maybe the smartest. London was growing fast. Daniel in Hong Kong was tall and well-liked upstairs.
And these guys were making millions in bonuses, more about beating each other than needing the cash.
Yeah, the anecdote about one losing his whole bonus on a currency bet and shrugging it off, it's a different world.
And power was shifting, right? Away from New York towards London and Hong Kong.
Definitely. And John Kinread in Tokyo, though not a horseman, was a huge revenue engine too.
So the New York guys were fading a bit. Bernardet spending time in D.C., Judderson getting angry, playing chess, running betting pools.
Yeah, Judderson sounds like he was losing control and not handling it well. Erratic management style.
Okay, so let's talk about one of their big products, PRLS, Principal Exchange Rate Linked Securities.
Ah, yes. Sounds like a bond, issued by someone reputable, maybe even a government agency.
But the payout, getting your principal back, depended on foreign exchange rates.
Exactly. Leveraged currency bets hidden inside a bond structure. Your principal wasn't safe like a normal bond. You could lose it all.
That's the key information asymmetry again, isn't it? The bank knows. The buyer often doesn't.
Precisely. It's a type of structured note, basically a customized bond with sunky payout rules based on some formula. Huge market for these.
And Morgan Stanley cleaned up selling PRL globally. To who?
Partnoy divides them into the cricks and the widows and orphans.
Okay, the crook.
Sophisticated types may be insurance managers who wanted to bet on currencies but couldn't do it directly, so they bought PRLs because it looked like a bond and fit regulations.
Sneaky, using the structure to hide the speculation.
Right. And the brokers found the marketing line downside limited to initial investment. Pretty funny. You could lose everything.
And the widows and orphans.
Less sophisticated buyers. They saw the reputable issuer, maybe a slightly higher interest rate, and just didn't understand the currency risk embedded in the formula. They thought it was just a safe bond.
Meanwhile, Morgan Stanley isn't taking the currency risk themselves.
Nope. They hedge it away. They make their money on the FAD commissions, which were way higher than for regular bonds, over 4% on some deals.
So they lock in profit, client takes the gamble, win-win for the bank.
Pretty much. The crooks used it for regulatory arbitrage. The widows and orphans got taken for a ride.
This seems to connect to that idea of the forward yield curve he mentions.
It does. Understanding where the market thinks future rates are going is key to pricing these things. It's implied by current rates.
So if you understand forward curves and the client doesn't,
Big advantage. You can structure bets against their lack of knowledge.
and PRS, being complex, were perfect for that, especially longer-term ones where the day of reckoning was far off.
Exactly. More profitable than simple bonds, easier to sell to the uninformed.
That story about the insurance CFO is brutal. Buys PERLS thinking they're safe agency bonds.
Then bam, huge losses. He calls the broker, who basically blinds him with science about currency devaluation and option time decay.
And the CFO realizes they were gambling on FX without knowing it. And the broker.
Bragging about how he ripped his face off and pocketed a huge commission. Chillin' stuff. And this PERLS concept wasn't unique to Morgan Stanley, right? Other banks copied it.
Yeah. Partnoy saw similar structured notes at First Boston. That's where his view of gambling really shifted.
From guys betting thousands on dice games to institutions unknowingly betting millions, even billions, on hidden currency risks in structured notes.
Right. And at First Boston, he was in non-dollar trading, selling bonds in foreign currencies.
But not the really risky emerging market stuff. That was separate. Until this Thai bot deal came up.
Ah, the Thai bot link structured note. Sounded good, high interest, but potentially toxic.
High commission, high risk. And weirdly issued by a U.S. government agency, even though it was linked to Thailand.
And the offering document. Internal use only. Confidential, but given to clients. Plus, tons of fine print saying, don't trust this.
Standard practice, apparently. Legal cover. The lawyers knew these things could blow up, so they put disclaimers everywhere. First Boston was actually ahead of the curve on that.
So the bank protects itself, the broker makes the sale, worries about lawsuits later, or just moves to another firm?
Pretty much. The focus is on the upfront profit. Partnoy's big realization, making money often meant hurting the client.
So what was the Thai deal, specifically?
One-year note, juicy 11.25% interest, U.S. agency issuer. Sounds great.
Okay.
Principal repayment depended on how the Thai bot moved against a basket of other currencies. Dollar, yen, Swiss franc, mostly. You could lose a lot, maybe get nothing back.
And the justification for this weird structure?
First, Boston claimed they knew the secret formula the Bank of Thailand used to manage the bet. So the high interest was compensation for taking that specific currency risk.
So you were betting on First Boston's secret intel about the Thai central bank?
Exactly. A huge gamble disguised as a bond. And we know how that ended later, with the '97 crisis.
So many questions. Who bought this? Why did First Boston hedge it? Why the U.S. agency? How much did FB make?
Partnoy wondered too. He asked the broker who bought it. Initially, secrecy. He guessed hedge funds maybe? Soros? Tiger?
Nope. They were too smart, could do it themselves cheaper. Other banks? Mutual funds? Also unlikely.
The answer was stunning. Government pension funds and insurance companies.
Unbelievable. Wisconsin, Orange County later mentioned. Why would these conservative places buy Thai bot risk?
The broker's explanation. The U.S. agency issuer gave it a high credit rating, a AAA or AA. For insurance companies bound by rules about credit quality, this was maybe the only way they could get exposure to FX markets.
So the rating masked the real risk. Regulators saw the AAA issuer, the short term, and missed the embedded currency bet.
That seems to be the loophole, a regulatory blind spot.
And the U.S. agency gets cheaper funding because buyers like the rating even while taking this hidden gamble. Wow.
A dice game wrapped in a government agency wrapper, as Partnoy put it. The risk only surfaced when losses hit.
Okay, so Partnoy finally lands at Morgan Stanley, goes through legal briefings, warnings about confidentiality, destroying old First Boston stuff.
Standard CYA. Protect Morgan Stanley's secrets now.
But when he meets the horsemen, what do they want to know?
What clients is he bringing? What deals? They were disappointed he didn't steal anything physical.
Including his dice game.
Ah, yeah, that computer dice game he made at First Boston. Apparently it was legendary. Trading stopped when people played it.
He gave copies away because managing the bets was too stressful, but forgot to make one for himself before leaving.
And his new bosses at Morgan Stanley seemed genuinely annoyed he didn't bring the game, like it was part of the hiring decision.
It's bizarre, shows the culture maybe. He wanted to be seen as ethical, but they wanted his gambling game.
Priorities, right. And he needed to impress these guys, the four horsemen. His future depended on them.
And we learn the hierarchy. Managing director, principal, VP, manager, his starting role, analyst, secretary.
Standard structure. But compensation in DPG was generally higher across the board than in other divisions. They were the rainmakers.
Okay, so we've covered a lot. Partnoy's journey into the heart of Morgan Stanley's derivatives machine in the mid-90s. It's a picture of, well, extreme profits, extreme risk, and some pretty questionable behavior.
Definitely. We've seen that aggressive culture, the complexity and secrecy around derivatives like PERLS, and that Thai note, the sales tactics.
Some real aha moments, I think. That contrast between the safe facade and the risky reality.
And exploiting those regulatory loopholes using government agency issuers.
The sheer pressure on the trading floor, the culture clashes, the obsession with money.
It really gives you, the listener, who wants to understand this world quickly but deeply, a concentrated look at a pivotal time. You see the forces shaping finance today.
So the final thought to chew on, you look at the incentives back then, the information gaps between banks and clients selling these complex products.
How much has fundamentally changed? If you're engaging with complex finance today, what questions should you be asking that maybe those pension funds and insurance companies weren't asking back then?